about the unique lens you probably have in due diligence, given your deep finance background. What are some things that you look for that maybe others might not, given kind of how deep you are in that space?
Yeah. So with a investment banking lens to everything, I tend to focus a lot on the exit opportunities for the company. So I know that's really a long, term for angel investors, but you have to think for a startup company, there has to be an exit. So is the exit going to be an IPO? Is it going to be a sell side? What does that exit look like? So a lot of things that you focus on is how the management team think about its runway, think about its exit. And the biggest reason that startup fail, despite being a great in terms of product, is running out of cash. And so the exit is a huge, huge opportunity for the company to realize the profit for the investors at the same time as having a pathway to success. So for me, I have a lot of focus on what is the potential for this company to be listed on the public exchange or as a potential acquisition target for a larger company in terms of consolidation. Consolidation happens all the time in our space, especially right now in the current COVID market. And I think that you really have to come in with a lens of what is the end game for the company? What is it going to be going forward for the next 5 years, but what is the exit opportunity? And so that is something that I'm very much focused on in terms of what I look at. Sorry, 1 second.
No worries.
There was a video screen pop up on my Zoom. And then from my operational experience, what I tend to focus a lot on investing is more on the business model rather than just looking at the financials. And obviously that depends a lot on the stage of the company. If you have a much later stage company, you have more KPIs to look at, more financials. But for a very early stage company, you often don't have a full built out business plan, or you do have a business plan, but you don't have a full built out model. And sometimes, the revenue projections are extremely non-realistic to put into realistic terms. And sometimes they're very much a stretch. And so everything you look at has to be around the actual business, the actual technology. One thing that I find extremely important is management team. Because at the end of the day, for early stage companies, it is the management team, and oftentimes not just the founder, but it's the entire management team that's able to take this company from the early stage into the growth stage and into later. So pay a lot of attention to how the management team, what they've done previously. It's okay to be a first-time founder, but sometimes you do see a lot of serial entrepreneurs know more what they did. They've had experience. They kind of come across a similar situation in their past startups, and they can really try to take the company, whether it's failing startups or something, they can really take that lesson and build it on their current venture. So I think management team is probably more important in an earlier stage startup than a later stage startup. As the company sort of matures, you tend to focus more on the financials, you tend to focus more on the KPIs, the metrics, and then more on the execution of the plan. But in an early stage company, you really need to focus on, does the business model make sense? And sometimes you need to have a sort of a common sense approach to it. And as angel investor, you might not have all the access to information, or you might not have, the technology kind of technical due diligence that an institutional investor has. But sometimes you can actually be very resourceful in the due diligence process. So one of the company I invested in, they were in the beauty e-commerce space. And so what I did is I went onto YouTube and looked at YouTube influencers, putting on videos of the beauty hauls they've done from this company. I went to chat room to look at, how their customers are talking about reviewing the company. So there are all these little data points that maybe an institutional investor are not even focusing on. But you as an individual investor can really think about it, would I be a customer of this company? Would I want to use it going forward? So there are a lot of resources that you can take. So that's just one example. But at the end of the day, you are investing in the management team, in the business, and in the entire company. So you have to really bifurcate everything and sort of look at everything as a segment of its own. But it does depend very much on the stage of the company.
Got it. What tools do you use? Maybe we can be explicit to help folks watching. What do you use to organize your thoughts? What do you use to sort of help you gather information?
Yeah, so I'm actually kind of old school. I write a lot of things down. I do constant note taking. So when I'm looking at companies, I actually have about 10 notebooks, like basically just jogging down every single notes that I've taken. And I know there are people who uses, Evernotes and all the, note taking apps. But sometimes pen and paper is really helpful. A lot of times I meet with someone for a couple times, and I can flip back to see, okay, this is what they said then. And investing is a long-term process. Sometimes you don't invest the first time you meet the company. You actually follow the management team and you actually follow the company for a very consistent period of time to see how have they delivered on what they were gonna, what they promised to the investors and to the shareholders. I'm a huge note taker, so I know it's kind of old school, but it's just like something I do. I also do a lot of note taking on apps as well, but I sometimes find write things down. Natalia mentioned this in the previous panel, but write things down and write down kind of your takeaway as well. So don't just write down what the management team is telling you. Think about it in your own mind. Does it make sense? Sometimes it takes common sense. Like, is this right? Like, have a curiosity and this kind of skepticism to what you're being fed with. And management teams and founders are often thinking in a very grandiose vision. So they think about, here's the best case scenario, here's what it could be. So it's up to you as an investor to say, does that make sense? Like, could it go down the opposite direction? Could it actually, be a huge disaster? And so always do a lot of your own diligence in terms of, if the net promoter score is great, look on the reviews, like look on reviews on Yelp, Google, whatever, Glassdoor reviews, like everything is out there, I think, in this current day and age. So it takes you to kind of be resourceful and dig up those little tidbits of knowledge and try to synthesize it kind of in your own mind.
Yeah, if I could sort of extract one thing from this, it's when you do your due diligence, almost go down the rabbit hole, like go and
Yeah.
go to the source, be it the customer, be it the employee.
Absolutely. Absolutely. Like, try to get to the primary source. Don't just rely on hearsay. I think in terms of investing, especially early stage investing, we tend, and I do this all the time, I tend to believe in what the founder tells me and then sort of view everything with that like color rose lens. But sometimes you really need to take a step back and kind of think about what can go wrong. And sometimes financials are only half of the story. It's right, you have to focus on the runway, you have to focus on what the company is doing in terms of its metrics. But a lot of times, look at the founder's integrity, look at things that's not presented in the investor deck. A lot of times, you'll find little tidbits of information that's more valuable than what's actually presented on paper. And as angel investors, sometimes you don't have access to, constant conversation with the founder. Like, listen to their podcast, go onto YouTube to find if they speak at any kind of events or conferences, and do your kind of research that way as well. One of the most recent, I did an investment about a few weeks ago. I basically had one opportunity, one conference call with the CEO and founder. And so it was like, gather all my thoughts, do my homework beforehand, and then really use that opportunity to ask the questions I want to ask tough questions. Any question that makes the founder be uncomfortable, you're asking the right question. And most of the time, they have things that they're uncomfortable talking about. They just don't talk about it. So really think about, these difficult questions that you can ask the founder and the management team. Try to meet more than just the founder. Try to meet with the rest of the management team. One thing I found is it's really hard for one person, one founder to run a successful company. It really takes a team. So in addition to what the founder is doing, what are the other, see what the head of marketing is doing, see what the head of finance, the lead salesperson. It really takes a team to build a great company. So that's about the diligence part.
So let's talk a little bit about diligence as well. So unlikely every box is going to get checked. Unlikely everything is going to verify. At some point, you just have to make a decision. How do you decide when there's if missing information or things aren't perfect, which they're unlikely to be? How do you still say yes? What gets you across the line?
Yeah. So there's some things that you can ignore, and then there's some things that you can't ignore. So what I consider to be red flags are things that you cannot ignore. So if those things pop up, like really focus on them. And red flags could be, founder control or different, different classes of investor, investment vehicles, too many, individual investor or too many small investor on the cap table. These are all things that you should take a second to focus more in and try to get behind. There may be a story behind every single one of them, but sometimes, you have to kind of dig another layer more. But then there's some things, that are a circumstantial. So for example, there was one investment I looked at a few years ago, and I had so much conviction on the company. They were at the time pre-revenue, pre-profit. It was a relatively newer company, and I had so much conviction because I kind of knew this space, and I was focusing on my conviction based on market size, based on the management team, based on the business model. At the time, I took it to my investment committee, and I got turned down like multiple times. And at one point, and this is sort of related to how I started doing angel investing, the investment committee said, if you put in your personal money, then we might consider it. And I'm like, I didn't even know I could do that. I have the conviction, and I'm going to put in my personal money, and I did it for that one. And later on, that company ended up getting a serious number of competing term sheets from great investors, well-known investors. And unfortunately in Silicon Valley, sometimes there's a herding mentality. So if no one is looking at the company, no one wants to touch it. But as soon as that company got so many great investors and term sheet, then my IC is like, oh, can we get some allocation? I would want to invest in that company. So sometimes you have to kind of remember your own thesis and have conviction. I think that's one thing that's separating VC investing apart from a lot of the other asset classes. In the stock market, if you're a contrarian, sometimes you do really poorly because you have to go with the flow sometimes. But in venture investing, really, it doesn't hurt to be a contrarian. It doesn't hurt to be underdog. What really matters at the end of the day is your thesis is proven to be correct. So that's just one example. Sometimes there are uphill battles, and you just have to kind of believe in your gut, but that has to do with you've done your homework and what you know to be right. If it's something really red flag, so for example, if the founder has a significant control in in voting shares, but not the same alignment of financial shareholding, that could be a red flag. That is something you have to pay attention to. So there are things that you have to pay attention to that I think are red flags, and you should walk away despite having some kind of just gut feeling. And then there are things that I believe can be slightly minor, and then you can actually focus on the bigger picture.
If you were to look back at your earliest checks, what's some advice you would give yourself as you were just getting started, given now?
Yeah, I think my earlier check tend to be slightly bigger than I would want it to be. So, at the time I was investing, Republic as a platform is extremely new. So, most of my deals were kind of the traditional Silicon Valley deals that, the founders go around and try to find investors in the Valley, and then you follow a check size from a lead investor. So I think in angel investing, you have to treat everything as if you could just potentially lose it all. So don't try to put all your eggs in one basket, no matter how much you believe in the company. And look at it almost in a very long term, like 7+ years investment. Don't go with the flow, and don't just count on like a quick money. You're not going to get that. For the checks I've written with my personal money, sometimes I feel like, oh, like I don't see liquidity soon enough. But at the same time, you need to know this is the game you're getting into. And sometimes you might not see liquidity. Sometimes you'll see liquidity, but it goes down the drain. Sometimes they're down rounds. So have a lot of patience. That I think is one of my weakness. Have a lot of patience. Keep on believing your own conviction, but do all the homework and focusing on, pay attention to the red flags in deal structure, in, diligence. There are a lot of them, and just believe in kind of your thesis and write everything down. Like, if you're wrong, then it's good that you actually have the foresight to know. And don't get into this FOMO stage. I used to have a lot of FOMO in my earlier deals, investing, because the deals that I believed in and took them to IC ended up getting passed. And then I see how successful they were after, the investment committee passed, and I have this FOMO, like I had access to that deal. It happens all the time. So just kind of do your own way, have built out your own road, and just keep on moving forward.
Let's talk a little bit about maybe we have just a couple minutes left here. One question, we'll try to get to questions from the audience, but one question that I like to think about is, as you were getting started, were there any angel investors that you sort of were modeling after, or that you thought you could learn from? And if so, what were the 1 or 2, 3 things that you kept in mind that you said, this angel investor did this, and so I'm going to try to do the same thing? Did you have any kind of mantras or guidelines that you were kind of following?
Yeah, so for me, I didn't start out being an angel investor. I was just an VC investor, and I just ended up doing my personal money. So I followed a lot of VC funds. So it was really following institutional funds and seed investors. Not exactly individual investors, because I think, so for me, at least, the deals I invested in were 2 camps. One is super early, usually pre-pricing round, so usually seed stage or pre-seed. And then the other bucket is slightly later, where I'm effectively a co-investor along with a lead investor. So it's really different, and they have very different term sheets have very different, deal terms, and your access to the management team and your level of control is also very different. So, luckily for me, I have a direct line of access to all the management team that I invested in. But, if you're investing through the platform, you might not have that. So, I think I model myself a lot in just, I want to invest in what I believe in. I think investors, at the end of the day, you're an investor. So, invest in what you believe in, invest in what you know. And think about it as, am I a consumer of this business? Can I be an investor? Usually, if you like the product from a consumer, you will be successful as an investor. If you hate the product as a consumer, don't invest. So sometimes it really is that simple. When I was in banking, we have this this phrase. We say, you eat what you bank. So typically for us in consumer retail banking at the time, I would use products that are my clients because you believe in them and you want to experience it. Right. So in a way, VC investing is that you want to touch and feel every aspect of this company that you want to put in money to, and by putting in money yourself, you're really becoming a part of it, right? As an angel, you should think about, what can I do to be helpful to the company, no matter how small. And sometimes you do need to focus on that to, get allocation. So, as my personal check, I'm really a lot of times just thinking about ways that I can be helpful, me personally can be helpful to the company. So look at your network, think, put yourself in the shoe of the founder. What do they need? One example is, one of this company I invested in, I connected them with someone who's the head of corp dev at this travel company, that they can do a potential business partnership, and they actually end up doing it. So think about ways that you can add value. And this is what institutional investors are doing as well. They're thinking about ways that they can bring value to the table. Most of the time, they have a board seat or some kind of a board observer seat, so they can actually be vocal. If you can, as an angel investor, you should still figure out, I want to be involved. I'm part of this community. I'm part of this company. What can I do to be helpful?
Yeah, makes sense. I think we're actually up on time. Thank you. That was super interesting, and I think a lot of great takeaways. Cheryl, I'll let you kind of bring it back and take over, but thank you.